Let's talk about crypto, the digital money that's been making headlines, minting millionaires, and just as quickly, breaking hearts. For years, the crypto market has been a roller coaster, but nothing quite prepared investors for what happened this September. This wasn't just another dip in the charts, it was a full-blown bloodbath, the kind that leaves even seasoned traders questioning everything they thought they knew. The market just had its worst month in years, sending shockwaves through the entire financial world. In September, the market didn't just dip, it nosedived, losing over $162 billion in days. That's more than the GDP of some small countries, wiped out in the blink of an eye. Charts everywhere turned red, and panic started to spread like wildfire. Traders watched in horror as the total market value crashed to $3.8 trillion. Screens flashed with alerts, and social media exploded with disbelief and fear. For many, it felt like the ground had disappeared beneath their feet. On September 22nd alone, $1.7 billion in positions were liquidated, wiping out over 400,000 traders. That's hundreds of thousands of people, from first-timers to pros, seeing their investments vanish in a matter of hours. Leveraged bets, those high-risk, high-reward plays, were the main casualties. When the market turned, these positions unraveled fast, turning what could have been a bad day into a full-blown disaster for anyone caught on the wrong side. So, what triggered this historic crash? It wasn't just one thing, it was a perfect storm of bad news and uncertainty. Confusing signals from the US central bank left investors guessing about interest rates. An economic slowdown loomed, global conflicts rattled nerves, and new regulatory fears piled on, making everyone wonder if the rules of the game were about to change. The result? A market panic that left both pros and newcomers reeling. People who thought they were prepared found themselves scrambling, and the sense of uncertainty was everywhere. In the next scenes, we'll break down what went wrong, who got hit hardest, and what it means for your digital dollars. Whether you're a crypto veteran or just crypto curious, understanding this crash is crucial for anyone navigating the digital economy. Buckle up, this is going to be a wild ride. Let's dive in and uncover the lessons from the September bloodbath that shook the crypto world to its core. When crypto crashes, all eyes turn to Bitcoin, and it just fell from $122,000 to $111,000 in a matter of days. Ethereum followed, plunging to $4,000 before barely recovering. Altcoins? They got obliterated. Solana dropped 7%, meme coins like Dogecoin and Floki lost over 9%, and even XRP fell 4%. The entire ecosystem bled, proving that when Bitcoin sneezes, everything else catches pneumonia. Billions in wealth evaporated, hitting everyone from big funds to small investors. September 2025's altcoin apocalypse was a brutal lesson in just how fast fortunes can vanish. In crypto, momentum is everything, and when it turns, the exit gets crowded fast. The pain was everywhere. So, what caused this digital disaster? To truly understand the chaos that unfolded, we need to look at the bigger picture, a web of interconnected events that sent shockwaves through the financial world. It wasn't just one thing, it was a series of unfortunate events, each amplifying the next, that led to this unprecedented market meltdown. It was a cocktail of bad news, each headline more alarming than the last. Every morning seemed to bring a fresh crisis, and the sense of uncertainty only grew stronger. Investors, already on edge, found themselves bombarded with negative reports from every direction. The US Federal Reserve cut rates, but with a gloomy outlook, spooking investors instead of reassuring them. Instead of calming the markets, the move was seen as a sign that things were worse than expected. Confidence, already fragile, began to crumble as Wall Street braced for more bad news. Weak job numbers and rising underemployment signaled a slowing economy. The labor market, once a pillar of strength, now looked shaky. People worried about layoffs, and businesses hesitated to hire, creating a feedback loop of anxiety and caution. Global tensions, especially between Israel and Iran, sent investors fleeing to the safety of the US dollar. Geopolitical risks made the world feel even more unpredictable, and the rush to safe haven assets only intensified the pressure on riskier investments. When the world gets nervous, speculative assets like crypto get hammered. The volatility that once attracted thrill seekers now became a liability, and panic selling swept through the digital markets. Suddenly, the promise of quick gains was replaced by the fear of devastating losses. Meanwhile, talk of stricter regulations in the US and Europe added more uncertainty. Lawmakers debated new rules and rumors of crackdowns made investors even more jittery. The regulatory environment, once a distant concern, now loomed large over every decision. Crypto thrives on confidence and liquidity. Both were in short supply. With exchanges closing and trading volumes drying up, it became clear that the market's foundation was far shakier than many had believed. The result? A perfect storm that the market simply couldn't withstand. Every factor combined, creating a cascade of losses that rippled across the globe. The sense of panic was palpable and no one was immune to the fallout. This wasn't just a blip, it was a full-scale rout. The speed and scale of the collapse left even seasoned professionals stunned as assets tumbled and fortunes evaporated almost overnight. When fear takes over, even the strongest coins can't escape the fallout. The market's collective anxiety became a self-fulfilling prophecy, dragging down prices and erasing months of gains in a matter of days. That's how we got here. A chain reaction of fear, uncertainty, and doubt, each link in the chain making the next one even stronger. The digital disaster wasn't just about numbers on a screen, it was about the psychology of the market, and how quickly confidence can turn to chaos. Here's the twist. While crypto crashed, the stock market soared. The S&P 500 and Nasdaq hit new highs, powered by strong earnings and the AI boom. Investors saw stocks as tied to real-world profits, while crypto looked like a risky bet on sentiment and liquidity. When the Fed hinted at trouble, crypto panicked. Stocks, buoyed by AI optimism, kept climbing. This split shows investors are getting smarter, choosing proven companies over pure speculation. Tech stocks thrived, but crypto's lack of anchors like earnings or dividends left it exposed. The divergence is a sign not all tech is created equal. Investors are picking winners, not just betting on hype. The gap could define strategies for years to come. September has always been rough for crypto. Call it the September curse. Historically, Bitcoin loses nearly 9% every September, but this year was far worse. Traders, expecting trouble, sold at the first sign of weakness, turning jitters into a self-fulfilling crash. Macroeconomic fears and global tensions poured fuel on the fire. The curse didn't just repeat, it hit harder than ever. This year's crash is a stark reminder. Ignore seasonal patterns at your own risk. In crypto, history doesn't just rhyme, it shouts. After a crash, traders hoped for a strong rebound, but this time, the bounce was weak and short-lived. Instead of a V-shaped recovery, the market limped sideways, showing little buying interest. That's a red flag. Buyers are scared, and sellers might not be done. Adding to the tension, $23 billion in Bitcoin and Ethereum options are about to expire, threatening more volatility. Major economic data releases loom, and bad news could trigger another sell-off. The market feels fragile, with every new headline a potential spark. Weak rebounds, looming expiries, and economic uncertainty paint a bleak short-term picture. For now, caution rules the day. The storm may not be over. But even in the wreckage, there are signs of hope. Despite the market downturn, there are several indicators that suggest a potential recovery on the horizon. US-listed Bitcoin ETFs saw $890 million in net inflows last week, meaning big institutions are quietly buying the dip. This influx of capital from major players indicates a strong belief in the long-term value of Bitcoin. This steady demand could help stabilize prices and signals long-term confidence. When institutions invest, they often do so with a long-term perspective, which can provide a solid foundation for future growth. The money supply is rising again, adding liquidity that often finds its way into riskier assets like crypto. Increased liquidity in the financial system can lead to more investment in cryptocurrencies, driving up prices. Policy changes could soon let Americans add Bitcoin to retirement accounts, unlocking huge new demand. If retirement funds start including Bitcoin, it could lead to a significant increase in market participation and investment. Sovereign wealth funds in the Gulf are eyeing crypto, and even a small allocation could move markets. These funds have vast resources, and their interest in crypto could lead to substantial market shifts. The long-term adoption story isn't dead, it's just taking a breather. The fundamentals of blockchain technology and its potential applications remain strong. Institutional money, rising liquidity, and policy shifts could all fuel the next rally. These factors combined create a fertile ground for the next wave of growth in the crypto market. The bulls aren't out of the fight yet. There is still a strong belief among many investors that the market will recover and reach new heights. In crypto, hope can return as quickly as it disappears. Don't count it out. The market is volatile, but with volatility comes opportunity. Stay informed and be ready for the next big move. Amid the chaos, some investors are turning to tokenized stocks, digital versions of real stocks traded on blockchains. Platforms like BitGet let you trade Tesla or Palantir tokens 24/7, blending the stability of stocks with crypto's accessibility. During the crash, tokenized stocks outperformed, cushioning losses for diversified investors. It's a modern way to hedge against crypto volatility without leaving the ecosystem. The concept is powerful real-world assets, traded globally anytime. There are still questions about regulation and custody, but the appeal is clear. Tokenized stocks could be the bridge between old finance and new. The recent crash may accelerate their adoption. Investors want innovation and stability. The September crash was a brutal lesson in crypto's volatility and its ties to the global economy. Leverage can amplify gains or wipe you out in minutes. The split between soaring stocks and sinking crypto shows investors are getting smarter about risk. Yet, institutional inflows and policy changes hint at a brighter future. The market remains fragile, with recession fears, regulatory uncertainty, and global shocks looming. Upcoming events will test crypto's resilience. The road ahead will be bumpy, but opportunity remains for those who do their homework. In crypto, the only certainty is uncertainty. Stay sharp, stay diversified, and respect the risks. That's the bottom line.